Stocks are at record highs, even as the U.S. government shuts down for the first time since 2019. With furloughed workers, missed paychecks, and weak jobs data, why are equities still climbing? The answer may lie in bonds, rates, and what investors see coming next. I'm Johanna Bota, and joining me today is StoneX's VP Global Head of Retail Dealing Desk, Alex Ridgers. Welcome, Alex.
Hello.
So, start with an explanation. How can stocks be at all-time highs with the government shutdown happening?
Well, I think, first of all, it's important to have a look at the shutdown and what it actually means. We've seen a lot of drama around it. So it's obviously not the first time this has happened. It's the 11th time since 1980, the first since 2019. So in reality, it is quite a regular occurrence. So what we've seen predominantly in the news is that, oh my God, we're talking about furlough, shutdown, people losing their jobs. It's not quite as bad as that seems, although, not saying it's easy for the people involved, but we need to dive a bit deeper into that. So the US government has a law, it's called the Anti-Deficiency Act. And what that means is, unlike something like the UK, where individual sort of government departments, etc., they can spend what they want.
Yeah.
They shouldn't be doing, but they can do. And then eventually they're like, oh my God, we're in massive amount of debt and the government has to fix the problem. So that works for councils and things like that. But actually in the US, which I think is a very good rule, they're legally bound. They can't spend anything that hasn't been allotted to them. Mm-hmm. So this is why, the question is, well, why doesn't the government just keep paying it? We know there's going to be a solution to this. And it's in law that they actually physically can't pay people.
Right.
People have to sort of be furloughed, and that's defined. So when we're looking at this, about going, oh my God, there's job cuts and things like that. In reality, there is furlough, but then there was, I think, after the 2019 shutdown was the last one. There's a further law, which it's a long name, I forget the name of it, which means that once everything is sorted, all employees get their money back, as it were. So in this way, markets, I think we've said over the recent months that markets get quite blasé about these things that they don't think affects them, and whether it's global supply chains, etc., getting a bit stronger, largely they see this as a temporary measure.
So doesn't this level of uncertainty, though, make current equity valuations hard to justify?
Yes, and I think we've seen it a lot, particularly sort of on the retail side, where there is that questioning: how can equities be valued as high as they are? But I really think I've got the solution. So I hope this video we can get to the bottom, of exactly why it's happening. So if we look at global bond purchases, sort of annual bond purchases, all right, it's sort of not inflows or outflows, but purchases. They exceed $20 trillion a year. So it's an incredible amount that every single year. When we talk about net equity inflows, and all right, this is the net, but they're only $1.5 trillion. So you think that when we talk about those numbers, it only needs a slight reallocation from government bonds into equities, mm-hmm. and all of a sudden you've got these rallies. So when we talk about why are equities so high, it's not necessarily sort of a case that the equity market is all wrong. It's a case of, well, it's the sort of the best alternative, as it were.
Okay, so basically you're moving because the government is not stable, and then you want to take it out of bonds and put it into equities.
Yes. So
I'm not saying you're saying that, I'm saying that's what's happening.
Yes, exactly. And I think we've very much got this sort of dichotomy where if you're an institutional investor, if you're an institution, a pension fund, you have this almost like a sort of fire hose of money coming in that you've got to put somewhere.
Yeah.
You can't say, oh, I don't like equity valuations, I'm going to do nothing. And so from their perspective, it's almost like, well, I'm still going to put lots of money in government bonds, but I've got to allocate this money. And actually, equities are still making money. There are gains there. It seems a far sort of more, so let's put a bit more of my allocation there. Whereas I think when you look from a retail perspective and a retail, they're not thinking that way. They're thinking the sort of almost the valuation of equities is too high.
Yeah.
But I think when you look at the valuation of equities and its stability compared to other assets, and I think, on that note, it's not just equities. We've seen it with cryptocurrencies since Donald Trump's come to power. Yeah, and as you say, and gold. So it's more of being the best alternative.
Yeah.
And from that perspective, it suddenly makes complete sense. Why are equity valuations so high? Well, governments are, can't. Gone are the times where we had sort of staid governments that would not break any fiscal rules, then you put your money in bonds. You know it's safe. Now, now you're not quite so sure.
It's switched. So we've got the shutdown. So do you think that we will get non-farm payroll report on Friday? And if we don't, what or how will that affect the markets?
Well, the likelihood is that no, we won't. But the good news is we've got an alternative.
Okay.
So, I mean, so first of all, thinking about non-farms, the expectation was for a lowly 50,000 increase in jobs, which, looking at sort of estimates, actual outcomes over the past couple of years, we're really getting to the low side now. No, that's pretty much the bottom. Then earlier this week, we had the ADP unemployment change, which, while it's sort of private sector, so it's not a mix of both, it's still a great indicator. So that we were expecting an identical amount, 50,000 there, actually came in minus 32. So net, we're firing, not hiring, or the US is anyway. So this was what caused the big equities rally we saw. Essentially, to sort of get everything back to, as everything is about Donald Trump. He's really succeeding. He's stifled the economy, which is having that knock-on effect of rates. So rates are dropping, but we've got more rate cuts to come, compared to say only one in the UK. So his plan, whether it's planned or not planned, that weakness in the economy is in equity markets are loving more, because they're like, well, great, more rate cuts to come.
And one last question before I let you go. How long do you think the shutdown is going to last for? The last one lasted 35 days, so give me your number. And next week I will...
Right, yeah, there we go. Well, it's the billion-dollar question, isn't it? And actually, I think, what's fascinating around the question is the longer it goes on, it has other implications. So if I'm guessing, I don't know, I think last time was a bit extreme. I'm going to go 14 days.
Okay.
To put it out there.
Okay.
No one take my advice on this. That's just a guess. But what's really interesting about all these lockdowns, that when they go on, or shutdowns, not lockdowns, although it seems the same with furlough, talking about furlough, is that the last 6, the S&P's rallied every time. So we think of it as negative, but it's like, well, if you sell into this thinking, oh my God, the government's shut down, I've got to sell, what happens when there's a resolution? All of a sudden, the natural thing is a rally. But I think the longer this goes on, we're going to see the rhetoric switching to the confidence in US credit. We've already talked about bonds and why not to invest in bonds. But I really think that's going to continue. And for me, either way, we're going to see a lot of volatility, because all of a sudden we're seeing these ideas of, again, talking about these sort of fire hoses of huge sort of inflows into capital markets. There's going to be big changes in the allocation depending on outcomes, So I think that's going to be big allocations means big market moves.
Well, Alex, I will hold you 14 days. Thank you so much. And thank you to our viewers for watching. For more financial content, don't forget to like and subscribe to our channel.